Hello and welcome to Money Control. Well, the market has pretty much reacted on expected lines to the escalation in conflict overnight between India and Pakistan. As we speak, Nifty is down about 1%, a little over 1%. We have some gainers, Titan, Tata Motors, L&T, some of the other defense stocks, etc. Over the next 2 days, of course, over the weekend, everyone will be watching how this conflict situation really, does it escalate? Is it going to settle down in the next few days, and the markets will react to it again on Monday. But before that, how do we look right now, or what cues do we take away from today's market and whatever as things stand right now? We have with us Nilesh Shah of Envision Capital. Nilesh, thank you so much for joining me.
Thank you so much, Mahalakshmi. Thank you to be on the show with you.
Sure. So the first things first, Nilesh, what is your reading today? This 1% move, is it, would you look at it as a complacent market, a muted reaction to what is happening? Or is this something that, as usual, like we have seen in the past, all the escalations, all the conflicts we have seen in the past, the day you do something is the day the market bottoms out. So this is that moment.
Well, the markets have been a lot more resilient than what was anticipated. And it's pretty much history repeating itself that whenever we've seen geopolitical conflicts happen, the markets do have a knee-jerk reaction. But after that, basically, the geopolitical conflict is taken in its stride. The market essentially kind of reacts and then moves on and focuses more in terms of the emerging fundamentals. I think this is pretty much a similar situation where probably, ever since basically the geopolitical conflict started, the markets have pretty much kind of been flattish, I would say. So to that extent, it's very heartening that the markets probably on a day like this are just kind of down 1%. And keep in mind that today is a Friday, we are entering into weekend. And despite that, the markets are just down about 1%. Had this been a normal weekday, probably the markets would not have been down even 1%.
Okay, so how do you explain that? Because this is a very nebulous situation in the sense that, we don't know what is to come. Or is it so are we just going with assumptions from the past, in which case we are still shooting in the dark?
So if I were to kind of, do a flashback and go back to, the longest geopolitical conflict that we've probably had in the last maybe 2 or 3 decades, it was around the Kargil kind of war, sometime in the late 90s. Even back then, maybe the markets were probably down about maybe 5 to 10% in totality. And even during that period, the global markets were down much more than us. So India actually outperformed during that episode of the last protracted geopolitical crisis. So clearly, from that point of view, we're not yet sure whether this time around it will be as long or as protracted as what we had seen in the late 90s. So I think there's some bit of a past experience. There's anecdotal evidence available, empirical evidence available. I think at some point of time or with the passage of time, I think there's a realization that ultimately it's going to be the macros, the fundamentals, and the earnings that matter a lot more than a simmering geopolitical conflict.
Okay. Nilesh, if we just build 2 kinds of scenarios that, this sort of, fizzles out in the next few days versus a situation where you could see some kind of conflict happening around the borders for the next few months, let's say 4 or 5 months, which is what happened in, I think, 1999. How will the markets take to it in these 2 different scenarios?
The view is that we've probably kind of the last couple of months have been relatively strong for the India market. Both March and April, I think between the 2 months put together, the markets have been up probably more than 10%. And on a year-to-date basis, we probably are more like kind of flattish. It's quite likely that the kind of strength which India markets have displayed over the last couple of months, you could probably go through some kind of a consolidation phase for maybe another month or 2. It's pretty much natural for the markets to do that after a steep rally, we do definitely see some consolidation. So I would probably think about March, May and June to be months of consolidation. I think probably the markets are going to digest the earnings season this time around. The markets are going to essentially digest the developments on the geopolitical front, and the markets are going to see the progress on the bilateral trade agreement with the United States. I believe that all of these factors put together is something which the markets are going to essentially kind of absorb, digest, and from there on, we are going to basically start the fresh uptrend. Maybe post, July onwards, we would have better color on the monsoons. We would have better color in terms of the consumption pickup. So all of these things are likely to play out over the next 1 or 2 months, and post that, we could probably have the resumption of a fresh uptrend for our markets.
Okay. And what kind of downside will you factor in? I mean, over the next 3-4 months, you said consolidation, but is there a possibility of, retesting the April lows? Could we go more than 5-10% over the next 2-3 months? What kind of chance would you attribute to that?
I would probably, put a less than 50% chance to that happening, because, we saw those lows sometime in February and early March. Between then and now, we're clearly seeing a set of big positive factors emerge. One is essentially the start of interest rates coming down. We're seeing basically liquidity condition becoming a lot better. Third is essentially crude oil prices have come off quite significantly. Many of the commodity prices have also started to come off. It also looks like that on the tariff front, India seems to be kind of relatively better placed versus many of our Asian peers. So all of these factors are there in the backdrop. In addition to that, if I were to kind of just look at some of the high frequency indicators for the month of April, the demand for jobs under Manrega has seen a decline for the first time in April after a gap of 6 months. Manufacturing activity for the month of April is at a 10-month high. So we clearly have the backdrop of a lot of these positive factors, which I think would make me believe that in a worst case scenario, we may retest the lows that we saw in February and March. But I wouldn't essentially kind of put a kind of a high probability to the markets breaking those lows that we saw in February and March. So I think in a worst case scenario, the lows of February and March could get retested.
Okay. And tell me more about, what is your take on Q4 earnings? Clearly, the actual numbers have actually surprised a lot of analysts in most cases. What's your take?
Yes, they have been positively surprising. I think we all went into this March quarter earnings season with a fair bit of caution. But unlike, and probably I think it's the IT services pack, the large IT services companies, where the results have been tepid to weak. But I think outside of that, it's coming in from consumer companies, from banks, from lenders, NBFCs, all have witnessed some pretty strong kind of an earnings season. And that's very heartening to know. And that sets a good tone for the coming financial year, because there are many other fundamental positives which will play out over the course of this financial year. So I think on the whole, yes, the earnings season has been kind of a bit more on the positive side than what was widely anticipated.
Okay. Nilesh, one of the factors that have sort of created this level of momentum in the last few weeks is also the huge amount of FII flow that has come into our markets, nearly $5 billion. How do you see this going? Do you get a feeling that this momentum will continue?
It looks like, I think it's the start of a kind of a change in terms of what they have been doing over the last few years. If I were to kind of look at between COVID and now collectively, I think the FPIs have essentially been neutral, and they have been net sellers. They've been more of net sellers over the last maybe two odd years. That's because their own home markets have done exceptionally well. More so, the US market has done very well. But clearly, the outlook for the US market essentially is not as bright as what it has been for the last few years. So I clearly believe that that's one reason why they will start to look for opportunities outside the US. Number one. Number two is basically the whole wave around de-dollarization. I think de-dollarization is a reality, which is that the dollar will probably not be as strong as what it has been. And therefore, markets like India are likely to benefit from this whole opportunity around de-dollarization. And third is basically that with crude oil prices coming down, India's macros are likely to look a lot better than what they have been over the last 1 or 2 years. So on the whole, the fact that India's GDP is likely to grow at 6% plus, nominal GDP growth at around 10%, softer crude oil prices, softer inflation, and lower interest rates, all of that point to very strong macros, and therefore India has become a lot more appealing to foreign investors, and I see that translating into flows not just in the short term but over the short to medium term as well. Additionally, Mahalakshmi, the FPIs have been underweight India. India's weight has kind of moved up quite significantly in the emerging market pack, but versus that, the exposure has been relatively low. I expect FIs to kind of have a catch-up trade on that side. So which all of these essentially kind of point to one single point, that flows from FPIs are going to likely significantly go up over the short to medium term.
Okay, cool. So on growth, getting back to growth, do you see any headwinds or risk to growth this year? At least, this quarter sort of has reignited confidence to some extent, because you've seen recovery much better than most analysts expected, like we spoke. Any headwinds or risks that you would like to call out?
I probably think the only headwind or the risk are again two things which kind of stem in from macros. One is if the US were to kind of get into a recession or a slowdown, that would surely impact our exports. Though exports are still a very small part of our GDP, but nevertheless, it does matter. So if there were to be a global slowdown or a recession in the US, that will impact our exports and will impact our GDP growth rate. Number one. Number two is with this geopolitical conflict. If this geopolitical conflict were to essentially last a little longer, if it were to linger, I guess the priority for the government would change. Maybe the spending on defense would probably go up. Maybe the spending on infrastructure might kind of get pushed back a little bit. And the third essentially is some of the consumer related spending, especially on things like travel, hospitality. Those are some of the things which might just take a bit of a backseat. So I expect some bit of headwind to kind of come up from some of these macro factors.
Fair enough. So that brings us to the question of, in today's market, where are the opportunities to buy and what should you be trimming?
So I believe from a trimming point of view, the large cap IT services companies is something which really kind of needs to be trimmed. These are businesses which probably will grow in single digit. So I clearly believe there's a case for that. In terms of buying more, I probably still think the domestic consumption oriented opportunities should essentially kind of find a place in everyone's portfolio. The second is the financials, especially the lending pack, I think looks very good. We have to also keep in mind that now the tax breaks which were announced in the last union budget for India's growing middle class will start to play out this year. That, along with lower inflation, will leave a lot more disposable incomes in the hands of the middle class. And then lower interest rates will essentially drive consumers to kind of buy more into homes and some of the other discretionary items. So I think on the whole, consumer pack, discretionary, non-discretionary, banks, lenders, and then the digital platforms who are using technology to reach out to consumers. I think these are some of the sectors or the themes or the pockets where investors should start to kind of look for buying opportunities.
Fair enough. Nilesh, but in the consumer segment, both in discretionaries and staples, what is your view on valuations? Are you comfortable buying at these levels?
Yes, I think in some cases the valuations are good. I mean, consumer space has never been cheap, and there are reasons for that because there is long-term structural growth sitting out there, backed with very strong capital efficiency. These are companies which generate a lot of, they just don't grow, but they generate cash flows. They sustain very high levels of return on equity and return on capital employed, because of which they probably deserve some of those premium valuations. So I think I would be extremely comfortable with the valuations right now, given that I see a multi-quarter kind of a period of growth coming back for these businesses.
And what are you avoiding? What are you selling? Pockets
So I think in this
find
environment, we're being
expensive and
very,
want to.
we're still kind of being very cautious on the large cap IT services space, number
IT,
one.
you said. Right.
Yes,
Right.
the second is basically the commodity space. Clearly, if there were to be a global slowdown, the demand for commodities would soften, which would lead to softening in terms of their prices as well. So I think out and out commodities, out and out large cap IT services, these are some of the pockets which one would avoid.
Okay. And what is your take on textiles and the overall China plus one kind of stories? Because at least because of this trade pact, of course, textile stocks have gained greatly, but there is also expectation that we will have better deals with Europe and US, and all that expectation also seems to be building in. So how do you size up this entire space?
Well, on this, our view is that one should be constructive, but one should still take a hard look at them, because while, yes, the gates are opening for India's textile sector into big markets like the United States or EU or the United Kingdom, but nevertheless, I still think we have a long way to go to achieve cost competitiveness. So that's the first thing. And second is that while the gates have opened, but basically if those markets were to kind of get into a slowdown or a recession, then maybe the demand for our textile products could still get postponed. So it's not that, they're not in a favorable position, but it might just be a bit more back-ended than what probably the markets have begun to price in right now.
So you will be cautious about textiles, you're saying?
I would probably think that one should just not get carried away with it. One should essentially realize that yes, there is an opportunity which has essentially has come up, but one should not just jump into the bandwagon right now.
Okay, how about EMS and similar, manufacturing space?
That's a very interesting opportunity. It's just that the valuations are, very, very high. The valuations, I think the entry valuations are just too high for, a comfort of a long-term investor. So I probably think that maybe one should wait for a entry opportunity there.
Okay. And what's your take on banks? Because that is also a big part of the index, especially private sector banks. And this entire rebound that has also come on the back of, banks going up primarily because of liquidity factors and so on. What is your take for the rest of the year? Do you think they will be able to build on these gains, or are we going to plateau here, or could there even be a correction?
Within the banks, I think the large banks have already kind of run up quite well in the last maybe 3 to 6 months. And the run up has been in anticipation of a lot of foreign flows coming in, and foreign investors have generally been liking India financials and Indian banks. So there's some bit of anticipation, but if I were to kind of look at their growth rates, the growth rates will be around 10 to 15%. Versus that, I still believe that the tier 2 banks, which have been, not so favorably placed in the last 1 year because of tighter liquidity conditions or because of regulatory actions or some bit of stringency on the part of the regulator in terms of tightening lending norms or capital adequacy requirements. But I clearly believe there's a change in terms of the stance of the central bank on both liquidity, interest rates, and some of the stringent regulatory requirements. So I probably believe that the tier 2 banks are more favorably placed versus the large banks. Also, I believe specialized lenders, especially on the housing finance side, affordable mortgages side, I believe that they would benefit quite significantly, especially in a falling interest rate environment as their cost of borrowings begins to basically come off. So we like the banking space, we like the lending space, It's just that we probably like the tier 2 banks and specialized lenders more versus their peers on the large side or on the large cap side.
Okay. Another pocket I wanted to talk to you about, because there is a lot of conversation around defense stocks now, because we are in this sort of conflict period. And in defense stocks, it's like, investors either love them or hate them. At least I see a lot of experts having very contrasting views. Where do you stand?
I think we like the defense opportunity. I think that's a long-term structural opportunity. Clearly, the whole wave of or the imperative of indigenization essentially augurs well for defense companies. Just that basically a lot of the defense stocks have moved up quite significantly in the last few months. So again, I would essentially advise caution from an entry point of view. If for any reasons there were to be correction in the stock prices, maybe that's a better entry point to kind of really look out for. So while the long-term prospects from demand, from growth, I believe are very, very strong, very appealing. It's just that the prices have to essentially kind of come off a bit for them to kind of present a compelling opportunity for long-term investors.
Right. Nilesh, one or two final questions. One is, apart from this geopolitical situation, the India-Pakistan situation, is there anything else that you would be watching out for, either some global factors to assess what could derail this momentum that we are seeing?
I would still believe that the X factor could still be on the trade and tariffs front. We have to keep in mind that basically the what was announced on 2nd of April, that was put a bit in abeyance till July, because as the US tries to kind of work out trade agreements with various trading partners. So for now, the markets are assuming that everything is going to be hunky dory, but who knows? Once the moratorium is lifted in July, I think it could just kind of create some bit of a negative surprise. So I'm not saying necessarily that discussions and negotiations around trade and tariffs will turn kind of negative, but who knows, if they don't turn out to kind of, if they don't normalize, then that may create one more layer of uncertainty for the markets. And so to that extent, I think that's something which we need to watch out for.
That is something we'll have to still wait till July to see what is the outcome, right? Anything else that you will be watching out in terms of, news, or in terms of numbers or data or anything to figure out which way you need to swing?
No, I probably think the only other thing can just be the monsoon from an event point of view. Come early June, we would see the first round of monsoon coming in. So far, the forecast on is of a normal monsoon, but who knows? I mean, the weather conditions can pretty much change. So those are some of the things which are probably, I would say, are the known unknowns. So that's one more area that one would want to kind of really look out for. But otherwise, beyond that, I would still think that beyond a period of consolidation between May and June, hopefully the market should resume an uptrend, from a few weeks from now.
And Nilesh, one final question, and we can probably end this on a more positive note as the week closes. What kind of probability will you assign to markets climbing back to the historical high within the next 1 to 3 months?
I wouldn't say 1 to 3 months, but I probably think between over the next maybe say 6 months or so, or for rest of the calendar year, I would expect the markets to kind of scale a new high by then.
You would expect a new high. Okay. On that note, thank you so much, Nilesh. Such a pleasure talking to you as usual. Thank you for watching this show. Stay tuned to Money Control for all your news, views, market updates, and also what is happening on the India-Pakistan front. Avoid all the fake news and log on to Money Control for the real news.